Welcome to the deep dive.
Uh-huh.
We're here to sift through the noise, look at the key sources, and really distill what matters for you.
That's the plan, giving you the essential insights without the fluff.
And today, we are diving deep into the thinking of someone who's, well, truly a giant in institutional investing, Howard Marks.
Absolutely. If you follow the markets, you know Marx. He's not about predicting the next big thing, not a market timer.
No, exactly. He's often called a bellwether of prudence. His memos from Oak Tree Capital, they're basically required reading.
Essential reading, for sure.
Yes.
He's the master of what he calls second-level thinking, always pushing you to look beyond the surface, beyond the obvious headlines.
To really understand the deeper currents, right?
Precisely. It's about understanding the why behind the what.
So today, we're unpacking his recent memo, the one titled On Bubble Watch, which came out January 7th, 2025.
Yeah. And that title alone, On Bubble Watch,
Yeah.
coming from Marx, that gets your attention.
It really does. This is someone whose entire philosophy revolves around risk management, preserving capital, not chasing wild gains.
So when he dedicates a whole memo to bubbles, well, you know it's going to be a thoughtful, serious exploration, not just number crunching.
And the timing. It's fascinating. It dropped exactly 25 years after his famous bubble.com memo.
That's right, January 2000. The memo was incredibly prescient, warned about irrational behavior in tech stocks.
And boy, was he right. And right fast, as they say. So the big question now is, are we seeing history rhyme? Is this 2000 all over again, just, a bit different?
Indeed. And what's so interesting is his very decision to write this memo now. It suggests the market's temperature, let's say, has hit a point where he feels this kind of deep assessment is necessary.
Just signal in itself.
Exactly. He's not yelling fire, but he's compelling all of us, compelling you listening, to move past those easy first-level thoughts.
To really examine the assumptions holding up the current market.
Right, to engage in that critical thinking. So our mission today, let's deconstruct his thesis from On Bubble Watch.
Let's put it side by side with that 2000 memo, see what's changed, what stayed the same.
Explore the strategic implications. What does this mean for how you should be thinking about your own portfolio in this, well, let's face it, complex environment?
Okay, let's jump in. The core idea. If it's not just about high prices, what is a bubble, according to Marx? How does he define it fundamentally?
That's the key starting point. Because for Marx, it's not primarily about the numbers hitting some magic threshold. A bubble isn't just a PE ratio getting too high.
Okay, so what is it then?
He argues it's fundamentally psychological. A
Yeah.
bubble is, in his words, a temporary mania. And he believes a psychological diagnosis is more effective than a purely numerical one.
A state of mind, basically.
Exactly. It's a period where, as he puts it, extreme events cause people to lose their objectivity and view the world through highly skewed psychology. It's when the market collectively loses its rational grip.
Driven by emotion, euphoria.
Precisely. Collective euphoria overriding reasonable assessments of value.
So if it's psychological, that makes it tricky to spot it, right? It's not a formula. How do we identify the state of mind?
Well, Marx doesn't leave us hanging there. He outlines 4 key elements, 4 signs that this kind of bubble psychology might be taking hold, things he's seen repeat over many cycles.
All right, what are these 4 signs? What should you listening be looking out for?
Okay, first element, highly irrational exuberance. This isn't just normal optimism about the future.
It's more than that.
Oh yeah, it's widespread, almost euphoric belief that just overwhelms rational risk assessment. It's that feeling that stocks only go up, that making money is easy, inevitable.
The narrative becomes everything.
Exactly. The story trumps the facts. People stop questioning.
Okay, that's one. What's number 2?
Second is an adoration of the subject assets. This is where investors develop this unwavering, almost religious faith in certain stocks, or maybe a whole sector.
Like they can't miss.
Precisely. It can't miss that kind of thinking. It leads to unquestioning confidence. People stop doing their homework, ignore bad news about their darlings.
They just buy because everyone else is buying it and it feels good.
Right. It becomes a symbol.
Got it. What's the third element?
The third one is critical for Marx. Massive fear of missing out, or FOMO.
Yes, FOMO. We hear that a lot.
And Marx stresses how this FOMO actually replaces the normal, healthy fear of losing money. Prudent investors are usually risk-averse, right? They worry about the downside.
Sure, capital preservation.
But in a bubble, that flips. The fear of being left behind, watching your neighbor or someone on social media get rich while you're sitting it out, that becomes unbearable.
So risk aversion just evaporates.
Completely. People start making bets they'd normally consider crazy just to get in on the action. It's a powerful emotional driver.
Okay, exuberance, adoration, FOMO. What's the fourth and final sign?
This last one, for Marx, is the surest sign of a full-blown bubble. It's when people develop a conviction that there's no price too high for these favored assets.
Literally hearing people say that.
He listens for that exact phrase or variations, like, well, sure, there's some price that's too high, but we're definitely not there yet.
Ah, the slightly more sophisticated denial.
Exactly. When that kind of talk starts, when valuation limits are just waved away, that's a huge red flag for him. It means the market's lost its anchor to reality. Fundamentals don't matter anymore.
Wow. Okay, so that's the psychological framework.
Hmm.
But theory is one thing. Where does Marx see these signs showing up in the actual market data of 2025? What's the concrete evidence of froth?
Right. He doesn't just leave it at psychology. He points to specific data. First, extreme market concentration,
Meaning?
meaning a few stocks dominate everything. Think about the Magnificent Seven, the 7 biggest stocks in the S&P 500.
Yeah, everyone knows them.
Well, as of late 2024, they made up something like 33% of the entire index's market cap.
33%. Just 7 stocks.
Yep. And get this, that's double their share from only 5 years before.
Wow.
And maybe more telling, especially compared to 2000. At the peak of the dot-com bubble, the top tech, media, telecom stocks were maybe 22% of the market. So concentration is actually higher now.
That's a stark comparison.
It is, and it's not just within the U.S. market. U.S. stocks overall ballooned to over 70% of the MSCI World Index.
70%. Global benchmark.
Yeah, a level of U.S. dominance not seen since about 1970. It means the whole world's market performance is riding heavily on these few U.S. giants.
So if those few stumble, the whole market feels it disproportionately. That's a big risk right there.
Yeah.
What about valuations? Are prices themselves sending warning signals?
Absolutely. Concentration is a systemic risk. And yes, he tackles elevated valuations head on. The S&P 500's forward P/E ratio was hovering around 22 times late last year.
Okay, 22x. How does that stack up historically?
Well, Marx cites data, I think, from JT Morgan Asset Management, showing that historically, when you bought the S&P 500 at similar P/E levels,
Yeah.
your returns over the next 10 years were consistently pretty weak, like in a tight range of +2% to -2% per year.
Ouch. So not exactly setting the world on fire from these levels.
Not historically, no. It doesn't guarantee a crash, but it strongly suggests future returns might be muted. You're basically paying a very high price today for expected future growth, leaving little room for error or upside surprise.
Okay, concentration, high valuations. Then there's the story, the narrative. In 2000, it was the internet. Today, it's obviously AI, artificial intelligence. How does Marx view the narrative of newness?
AI is undeniably the big, powerful narrative right now, a world-changing innovation.
No question.
But here's Marx's second-level thinking. The real danger of newness, he argues, is that there's no history, no precedent, meaning there's no past data, no historical cycle to compare it to, nothing to temper enthusiasm when something feels completely new and revolutionary.
The sky's the limit, psychologically.
Exactly. The "this time is different" argument becomes incredibly powerful. There's no historical map to say, hang on, maybe we're getting ahead of ourselves. He calls this lack of a map a great precursor for the kind of enthusiasm that sometimes leads to bubbles. It allows for almost unlimited speculation.
Because who's to say what the limit is?
Precisely. The potential feels infinite, which makes justifying almost any price much easier.
Got it. So beyond the Mag 7 and the AI hype, are there other, maybe broader signs of speculative froth or reduced caution that he points to?
Yeah, he mentions some ancillary evidence of speculative behavior and indiscriminate buying. For instance, he notes Bitcoin's huge run-up, something like 465% over the 2 years before the memo.
Right. Crypto definitely saw some wild moves.
He sees that kind of meteoric rise in a highly volatile, uncertain asset as a sign of just diminished caution generally, a sign that people are very comfortable taking big risks.
Where playing it safe feels like losing.
Exactly that feeling.
Yeah.
And he also raises an interesting point about passive investing.
Index funds and ETFs.
Right. He wonders if the massive flows into these passive funds contribute to automated buying, meaning money flows into the index and it automatically buys the biggest companies, like the Mag 7, pushing their prices up further.
Regardless of their individual fundamentals.
Potentially, yeah. It's buying based on market cap weighting, not necessarily on a deep dive into whether that specific company is worth that specific price right now. It can kind of feed the concentration and valuation issues.
Creates a feedback loop.
Could be. It becomes buying without necessarily thinking critically about each component.
Okay, so Marx lays out a pretty compelling case for being on bubble watch. Lots of warning signs flashing, but true to form, he doesn't just leave it there. He presents the Carver arguments too, right? Reasons why this might not be a 2000-style bubble ready to pop.
He absolutely does. It's crucial to understand his balanced perspective. It's never one-sided. First off, he says valuations are lofty, but not nutty.
Not nutty. Okay, that's an interesting choice of words.
It is. He acknowledges prices are high, expectations are definitely elevated, but he specifically stops short of calling them insane or completely untethered from reality, like some of the valuations back in 2000 clearly were.
So maybe froth, but not total madness yet.
That seems to be his read. More like a yellow warning light than a blaring red alarm, maybe.
And a huge part of that difference, compared to 2000, must be the actual companies leading the market today.
Exactly. This is probably the biggest counterargument, and Marx himself makes it forcefully. The Magnificent Seven are truly magnificent.
He says that.
He does. Unlike many of the dot-com flameouts that had no profits, maybe not even revenue, today's leaders are genuinely incredible companies.
They make tons of money.
Right. Fortress balance sheets, huge cash piles, low debt, dominant market positions, wide moats protecting them from competition, and crucially, massive, sustained profitability and cash flow.
So the argument is maybe they deserve these high valuations.
That's the strong counterargument, that their superior quality, their profitability, their exposure to massive growth trends like AI and cloud, maybe it justifies the premium price. It's not just a story, there's real substance there.
A much stronger foundation than pets.com.
Miles stronger. But then, even with all that, there's one key psychological signal Marx says is missing right now.
Okay. What's that? What ingredient isn't there yet?
He says very clearly, I don't hear people saying, there's no price too high.
Ah, that ultimate sign of capitulation isn't widespread yet.
Apparently not, in his observation. That complete abandonment of any valuation discipline, that willingness to buy at literally any price, he doesn't sense that's taken over the broad market yet.
So maybe some sanity remains, even amidst the excitement.
Perhaps. It suggests that while exuberance is definitely high, that final, crucial psychological line into pure mania hasn't been crossed by the majority.
Which leads to a really interesting point you touched on earlier, this idea that the quality of today's leaders makes things almost more deceptive.
Exactly. It's a paradox. Back in 2000, a lot of the crazy valuations were for companies that were objectively flimsy. It was almost easy to see the absurdity if you looked closely.
The emperor clearly had no clothes.
Right. But today, the market is led by arguably some of the best, most profitable, most innovative companies ever. This gives a powerful, rational-sounding justification for their high prices.
The grain of truth underlying the potential bubble is much bigger this time.
Much bigger, much more compelling. And that makes it way harder for investors, even sophisticated ones, to tell where the solid fundamentals end and the purely speculative excess begins.
The story is just so good.
It's incredibly good. The narrative of quality, of dominance, of AI changing everything, it can easily mask the dangerous assumptions baked into the price, like assuming uninterrupted growth, permanent leadership, no major competition emerging forever.
So a bubble in high-quality assets is sneakier.
Much sneakier, more insidious. Because the rationalizations are stronger, it can draw in more people, last longer. It demands a much more nuanced judgment, not just a simple good or bad call.
So stepping back, this balanced approach Marx takes, presenting both sides. It's not him being undecided.
Not at all. I see it as a deliberate rhetorical strategy. He says his goal isn't to declare a bubble, but to suggest how you might think about them.
He's trying to make us think.
Exactly. By laying out the froth and the quality, the warnings and the counter-arguments, he forces you, the listener, into that second-level thinking he champions.
Moving beyond just, is it a bubble, yes or no?
Right. To a more nuanced assessment of the probabilities, the risks, the potential rewards. The memo is a tool for your judgment calibration, not a prepackaged answer. It's about empowering your critical thinking.
That makes sense. And this focus on psychology, on how human behavior drives cycles, naturally leads us to compare now with 2000. How does On Bubble Watch stack up against Bubble.com? What stays the same? What's different?
Yeah, comparing the two memos 25 years apart is fascinating. It shows both the consistency in Marx's core thinking and how he adapts his lens to very different market landscapes.
How so? Let's start with the tone. Is it different?
Oh, significantly. In 2000, the tone in Bubble.com was urgent, direct, almost like a klaxon horn. He used words like overwhelming evidence. He famously said his cautionary stance felt like standing in front of a freight train.
Implying a crash was unavoidable.
Pretty much. It was an unambiguous call. This is a bubble, folks. Be extremely careful.
Okay, so very direct back then.
Yeah.
How about 2025's On Bubble Watch?
Much more Socratic, more circumspect. He actually goes out of his way to disclaim expertise in AI or even specific stocks. He frames it more as a thought exercise.
Inviting us to think along with him.
Exactly. Less of a top-down declaration, more of a shared exploration. And that reflects the market itself, right? It's more complex, more nuanced than the blatant absurdity of 2000. The diagnosis requires a lighter touch.
And does that shift in tone reflect a shift in his main worry?
I think it does. In 2000, his core concern was viability. Could these dot-coms ever make money? Many had no profits, flimsy models. The irrationality was about survival.
Easy to spot for a value guy.
For sure. But in 2025, the concern shifts to valuation. He grants that the Mag 7 are incredible businesses. So the question isn't will they survive, it's what's a sustainable price for this level of dominance and growth?
A much harder question to answer definitively.
Much harder. Valuation risk is subtle, debatable. Viability risk is often more black and white. So the shift in his approach makes perfect analytical sense, given the difference in the underlying assets and risks.
Okay, so the assets and the core risk have changed. But Marcus always comes back to human nature. Does he see the investor psychology rhyming, as he likes to say?
Oh, absolutely. That's where the consistency shines through. While the businesses are vastly different, the investor psychology, it definitely rhymes.
Crusoe.
His 2000 memo talked vividly about a lottery ticket mentality, a mania within a mania for IPOs that would pop instantly, and that powerful fear of missing out.
Sounds familiar.
Doesn't it? Now look at 2025's memo. He highlights the exact same drivers. FOMO is everywhere, especially around AI. There's the irresistible allure of the new thing changing the world, the powerful narrative overriding caution.
So the object of desire changes, pets.com becomes AI chips, but the human reaction is the same.
Pretty much. The greed, the envy, the herd behavior, the susceptibility to a good story, those seem timeless. The tech changes, the behavior patterns persist.
And we know how 2000 ended. It's worth reminding ourselves of the stakes.
Absolutely. The aftermath is a crucial lesson. The NASDAQ dropped nearly 40% in 2000 alone. And the vast majority of those high-flying dot-coms wiped out. 90%, 99% losses. Gone.
Fortunes vanished.
Completely. It's a brutal reminder of what can happen when speculative excess unwinds, even when the initial story feels incredibly compelling.
So this comparison really highlights Mark's consistent focus. It's always about behavior, psychology.
That's his anchor. Assets change, tech evolves, but understanding human behavior in markets, that's the key that unlocks understanding cycles, risk, and opportunity for him. It's why his insights feel timeless.
Which brings us nicely to his broader philosophy. On Bubble Watch isn't just a snapshot. It fits right into his lifelong framework on cycles, psychology, risk. What are the pillars of that Marxian framework?
Well, at the absolute core is this deep understanding of human psychological frailties in investing. He loves quoting the economist Charles Kindleberger.
What about seeing a friend get rich?
That's the one. There is nothing so disturbing to one's well-being and judgment as to see a friend get rich. Marx argues this envy-driven FOMO is what unhinges us from normal risk aversion.
It makes being careful feel stupid.
Exactly. You feel like you're missing out, looking foolish. That discomfort pushes people to take risks they wouldn't normally take. It's a fight against your own nature.
And this gets amplified by new things, right? Like AI.
Massively amplified by the power of newness. When something like AI comes along, genuinely new and transformative, there's no history to act as a brake. No past data to say, whoa, slow down.
So that this time is different. Story takes hold easily.
Very easily. It feels plausible because there's no direct counter-evidence from the past. It justifies almost any valuation because the potential seems limitless and uncharted.
And he uses that famous fable to illustrate the social pressure.
The emperor's new clothes. Brilliant analogy. He compares the pressure to conform in a hot market to that story. Nobody wants to be the one to say, hey, I don't see the amazing suit, or in this case, hey, isn't that price kind of crazy?
For fear of looking dumb or out of touch.
Precisely. Or worse, missing out on the gains everyone else seems to be making. So people stay quiet, go along with the crowd, even if they have doubts. That collective illusion keeps the bubble inflating.
It's a powerful image. And he also has that simple framework for market stages, the 3 stages of a bull market. Can you walk us through that? Where does he think we are now?
Yeah, it's a classic Marx heuristic, super useful for gauging the market's emotional temperature.
Okay, stage 1.
Stage 1 happens right after a crash. Everything looks bleak, fear is everywhere. Only a few contrarians, the really insightful ones, can even imagine things getting better. They're buying when blood is in the streets.
High risk, potentially high reward, but requires guts.
Absolutely. Then comes stage 2. The economy and markets start to actually recover. Earnings improve, confidence slowly rebuilds. Most people now accept that, yes, things are getting better. More investors come back in.
A healthier stage.
Generally, yes. Growing confidence, but usually still some respect for risk. And then, stage 3.
The danger zone.
That's how Marx views it. This comes after a long period of great news, strong returns. It's when, as he says, everyone concludes that things can only get better forever. Euphoria takes over, caution disappears, valuations hit extremes.
Everyone's a genius.
Exactly. And that's usually when things are most precarious, right before a fall.
So applying that framework to today, mid-2025,
Yeah.
where does Marx place us? Feels like we're past stage 1, maybe well into stage 2.
According to his assessment on Bubble Watch, yeah.
Yeah.
The environment of 2023, 2025, with strong returns, big inflows, and all this AI excitement, he sees us firmly in the latter part of stage 2.
Yeah.
And, crucially, showing clear signs of transitioning to that more dangerous stage 3. The psychology is shifting towards that can only get better forever mindset.
Which is why he's putting us on Bubble Watch.
Precisely. The temperature is rising, the warning lights are flashing.
And this brings us back to maybe his single most important principle, the one he hammers home constantly. It's not what you buy, it's what you pay. Why is price so primary for him?
It's the absolute bedrock. Good investing doesn't come from buying good things, but from buying things well. It sounds simple, but it's profound.
Meaning even the best company can be a bad investment.
Exactly. You find the world's greatest business, incredible prospects, but if you pay a price that already assumes perfection and decades of flawless growth, your future returns are likely to be poor. The quality of the asset doesn't save you if the price is wrong.
And this isn't just theory for him, right? He learned this the hard way.
Oh, yeah. He talks about his baptism under fire during the Nifty 50 bubble in the 60s and 70s.
What happened then?
He saw investors, smart people, lose 90% or more on stocks everyone agreed were great companies. Coke, IBM, Xerox, Polaroid.
Blue chips?
But they paid too much. Way too much. PE ratios of 60, 70, 80, 90 times earnings. The prices were built on impossible expectations. That experience seared into him the lesson. There's no asset so good that it can't become overpriced and thus dangerous.
Which directly challenges that idea of buy the Mag 7 at any cost.
Directly. It's his core warning. Even the best business can hurt you badly if you overpay. The future returns get eaten up by the high starting valuation.
Now, you mentioned his background is heavily in credit and distressed debt. How does that shape this intense focus on price, especially when looking at equities where growth is often the main story?
That background is absolutely key to understanding his mindset. As a credit investor, your number one priority is always capital preservation, getting your principal back plus interest.
The upside is capped, but the downside is losing everything.
Exactly. Your upside is limited contractually, but your downside can be a 100%. So naturally, you become laser-focused on downside risk, on margin of safety, on the price you pay relative to the certainty of cash flows.
He brings that debt mindset to stocks.
He does. When he looks at a high PE stock, he's not just seeing the potential growth story, like a typical growth investor might. He's seeing the enormous expectations baked into that price, and therefore significant risk of disappointment and capital loss if those expectations aren't met perfectly.
So avoiding losers is more important than picking the biggest winners.
For Marx, fundamentally, yes. It's about survival first, ensuring you don't suffer catastrophic losses. That's very different from, say, a venture capital approach, where you expect most bets to fail, but hope one hits it out of the park. Marx wants consistency and safety above all.
Okay, so we have his internal framework. But these warnings don't exist in a vacuum. They're amplified by what's happening in the broader economy, right? What's the macro context in 2025 that makes his memo even more timely?
You're absolutely right. His Bubble Watch lands amidst a really challenging and uncertain macro picture, which he explores in other memos too. It adds another layer of risk.
Like what? What are the big macro worries?
Well, first, there's the whole issue of tariffs and geopolitical uncertainty. In his April 2025 memo, Nobody Knows, yet again, he talks about the potential for new broad tariffs.
Import taxes.
Right. He calls this a seismic but unpredictable potential shock. Unlike normal economic cycles, tariffs are political, hard to predict. They could trigger retaliation, spike inflation, disrupt supply chains.
Potentially even cause a global recession.
That's the fear. And this kind of uncertainty, he argues, logically demands a higher risk premium from investors. That means valuations should theoretically come down because future earnings are less certain.
Okay, tariffs are one big uncertainty. What else?
Then there's the inflation and interest rate conundrum. The picture in mid-2025 is really messy.
How so?
You've got potential inflationary pressure from tariffs, making goods more expensive, but at the same time, there are signs of broader economic growth slowing down.
So the Fed is caught in the middle.
Exactly. The Federal Reserve has a dual mandate: keep inflation low, price stability, and keep employment high. But fighting inflation usually means higher rates, which slows the economy.
Hmm.
Stimulating growth usually means lower rates, which could boost inflation.
A catch-22.
A real bind. And this massive uncertainty about what the Fed will do next, hike, cut, hold, creates huge volatility. It makes it incredibly hard to figure out the right discount rate to even value stocks properly. That uncertainty itself can weigh on markets.
And given this shaky picture for stocks' high valuations, macro risks, Marx, being the credit guy, likely points to an alternative.
He sure does. It ties into his March 2025 memo, give me credit. With high equity valuations and all this uncertainty, he makes a strong case that credit bonds, private debt looks relatively more attractive.
Even if credit spreads are tight.
Even then. He argues the absolute yields you could get, maybe 7, 8, 9, 10% in some areas, are high enough to compensate for the default risk. And crucially, those yields look pretty good compared to the potentially low single-digit returns implied by current equity valuations.
So caution on stocks is partly because credit looks like a better deal on a risk-adjusted basis?
That's a key part of his argument. Why take on all the equity risk for potentially meager returns when you can get decent, more predictable returns in credit with less volatility?
Okay, so putting it all together, the tariffs, the Fed uncertainty, the relative appeal of credit, these things act like a fragility amplifier on the already existing risks of high valuations and concentration.
That's a perfect way to put it, a fragility amplifier. Think about it. A market with high valuations is already vulnerable if growth disappoints. A highly concentrated market is vulnerable if just one or two leaders stumble.
Right.
Now, throw in an unpredictable macro shock like tariffs or deep uncertainty about interest rates, it's like a potential pin aimed right at those vulnerabilities.
The combination is worse than the individual parts.
Exactly. It's synergistic. The tariff shock is more dangerous because valuations are high and concentration is extreme. The high valuations are more precarious because of the macro shocks. The overall risk isn't additive, it's multiplicative. The system becomes more interconnected and fragile.
Unsurprisingly, a memo like on Bubble Watch sparks a huge debate. It forces people to really examine their own beliefs, doesn't it?
Oh, absolutely. It's been like a Rorschach test, revealing core investment philosophies. Let's unpack the bull case first, the people who think, okay, Marx is smart, but this time is different.
What's their main argument?
It really centers on the unique quality of today's leaders, the Magnificent Seven. They stress these aren't flimsy .coms. These are companies with fortress balance sheets, huge moats, massive cash flows, real businesses.
So, the high valuations are justified by superior quality and growth prospects, especially with AI.
That's the core bull argument. These companies are exceptional, they dominate secular trends, so they deserve premium multiples. Some even argue the entire S&P 500 is structurally more profitable now, justifying permanently higher valuations than in the past.
Interesting. Is there also a critique of Marx's philosophy itself, like maybe his focus on price is too narrow?
Yes, that's a common philosophical critique you hear. Some argue his intense focus on purchase price, coming from his debt background, makes him undervalue the sheer power of owning a truly great compounding business for the very long term.
The idea being, if a company grows for decades, the starting price matters less over time.
Exactly. If you bought Amazon or Apple early, even if the PE looked high at the time, the decades of compounding growth made that initial price almost irrelevant. This view leans on asymmetric returns. One huge winner can pay for many losers. So, finding those winners is paramount, maybe more so than avoiding any possibility of overpaying initially.
It's about finding the needle in the haystack, rather than just avoiding the haystack altogether.
A good way to put it. It's a growth-first mindset versus a safety-first mindset.
Okay, that's the bull side. What about the bears? Those who find themselves nodding along with Marx? And what's the vibe among retail investors, the folks on Reddit and Twitter?
Well, plenty of commentators strongly agree with Marx. They see the psychological signs, the FOMO, the hype, and view the extreme concentration as a classic danger signal. For them, high valuations are always the enemy of future returns. Mean reversion is inevitable. It's just a matter of time.
They stick to the historical playbook.
Right. Now, the retail discussion is interesting. On platforms like Reddit, you see huge respect for Marx, but also some skepticism about applying his advice directly.
Why is that?
Well, some point out, correctly, his deep expertise is debt, not necessarily picking winning stocks. And his focus on avoiding loss might mean missing big upside rallies. You hear the phrase perma-bears, people always warning about a crash.
And the frustration that being too early is the same as being wrong, especially if the market keeps climbing.
Exactly that. FOMO is powerful. Sitting out a rising market is painful, even if you think it's justified long-term.
But you mentioned more sophisticated folks clarify Marx isn't actually predicting a crash.
Yes, and this is crucial. They emphasize he's not market timing. He's identifying an environment of high risk and low prospective returns. It's a statement about the current odds, the risk-reward balance, not sell everything tomorrow. That's a much more useful framing.
So as you said, on Bubble Watch really is like a Rorschach test. Your reaction reveals your own investment DNA.
Perfectly put. The debate isn't about finding the single right answer. It exposes that fundamental clash between two deep-rooted philosophies.
The value risk control school versus the growth quality compounding school.
Exactly. On one side, Marx, rooted in Benjamin Graham. Prioritize margin of safety, avoid losing money at all costs. Prudence first.
And on the other.
The school of thought perhaps exemplified by Philip Fisher, or parts of Buffett's evolution, prioritize finding those few exceptional companies that can compound for decades. Believe that long-term growth trumps near-term valuation concerns. Find the winners and hold on.
So your gut reaction to Mark's memo, he's spot on, or he's too cautious, tells you a lot about which camp you naturally fall into.
It really does. It forces you to confront your own core beliefs about how markets work and where value comes from.
All right, let's get practical. This brings us to the strategic implications. Marx provides this framework, these warnings. What does it mean for your portfolio? What actions or perhaps shifts in thinking does he suggest?
Yeah, the key takeaway isn't panic, it's think. It's a call to critically reevaluate your portfolio construction and your risk exposure in light of this potentially frothy low-return environment.
So the first step is deciding on your overall stance, offense versus defense.
Exactly. Drawing from his other writings, like Ruminating on Asset Allocation, Marx would say step one is to consciously decide your desired risk posture. How much offense, seeking growth, versus defense, preserving capital, do you want right now?
And in a frothy market like this,
a prudent adjustment, he'd likely argue, is to dial back from maximum offense, maybe shift towards a more balanced posture, or even tilt slightly defensive, reflecting the less favorable risk-reward outlook. Adjust the thermostat down a bit.
Okay, so conceptually, adjust the risk posture. What about concrete strategies? How do we deal with that extreme concentration risk we talked about?
The most direct counter is diversification. And not just across sectors, but maybe thinking more globally or down the market cap scale.
Look outside the Mag 7 and U.S. large cap.
Potentially, yes.
Yeah.
Actively seek opportunities in non-U.S. markets, small caps, maybe value sectors that have lagged. His memo implicitly critiques that passive automated buying, suggesting active choices might be more valuable now to avoid overpaying for the biggest stocks just because they're big.
Be more deliberate about where the money goes.
Right. Within your equity allocation itself, you might consider trimming the most concentrated parts, U.S. large growth, and maybe adding to more defensive businesses.
Companies less tied to the economic cycle.
Exactly. Stable earners, strong balance sheets, or tilting towards value styles or regions that seem less stretched, building more resilience into the equity sleeve.
And then there's credit, his preferred alternative right now.
Yes, as he laid out in Gimme Credit, consider increasing allocations there. He believes the yields on offer in public and private credit provide a better risk-adjusted return than equities currently. You get dependable contractual income, which looks attractive when equity upside seems limited and risky.
Generating income while equity growth is uncertain.
That's the idea. And finally, for those staying heavily in equities, robust risk management is key.
More than just buy and hold.
Maybe. This could mean diversification into other asset classes, real assets, commodities, or perhaps using options to hedge downside risk, or looking at structured products for capital protection. Basically, building a more resilient, all-weather portfolio.
Got it. So, beyond the specific moves, what's the ultimate overarching lesson Marx wants us to internalize from all this?
I think the ultimate lesson is behavioral. Success, especially in tough or frothy markets, comes down to having a sound philosophy and the discipline to stick with it.
Resisting the emotional roller coaster?
Absolutely. Resisting greed when everyone's euphoric, resisting fear when markets panic, focusing on what you can control, your process, your discipline, and the price you pay.
And that famous Marx quote,
Don't just do something, sit there. Especially when markets are frothy and FOMO is intense, it's a call for patience, prudence, thinking independently, resisting the herd.
having the courage to be disciplined when it's hardest.
That's the essence of it, which of course leads to a challenging question.
Which is,
In times like these, when optimism is high and easy gains seem everywhere, how many investors really do have the discipline to just sit there and stick to their plan? It's a real test of character.
indeed. So let's wrap this up. Howard Marks on Bubble Watch memo, it's not a crystal ball prediction of doom.
Not at all. It's a sophisticated framework for thinking about risk in a market that feels, well, complicated and maybe a bit dangerous.
By framing a bubble as a state of mind, he pushes you, the listener, to look past the charts and diagnose the market's psychology.
Right. He sees the warning signs, the concentration, the high valuations, the powerful AI story. But he also acknowledges the counterarguments, the sheer quality of the market leaders. It's a nuanced picture.
The bottom line seems to be, this isn't a time for complacency, not a time to just chase whatever's hot.
Definitely not. It's a call for you to take a hard look at your risk posture. Stress test your assumptions. Understand the dangers of concentration.
And whether you respond by diversifying more, adding credit, or using specific risk management tools.
The core message is timeless. Control your risk, stick to your discipline, especially when everyone else seems to be losing theirs in the excitement.
A powerful reminder. We hope this deep dive into Howard Marks' thinking has given you valuable food for thought. And that leads us to our final provocative thought for you to consider.
In a world increasingly driven by short-term noise, social media hype, and instant reactions, what does it truly mean for you to cultivate a genuine long-term disciplined investment philosophy? And maybe more importantly, how do you measure the success of that philosophy beyond just the immediate short-term market returns?